So the Indian stock market has experienced a sharp 5% decline over the past 5 days. And investors are wondering if this correction is just the beginning of a larger downturn or an opportunity to buy. So in this analysis, we'll explore why the market is falling and what factors are contributing to the drop and whether it's a smart time to start building cash positions or not. It's about the rising crude oil prices. One of the primary reasons for the market's current decline is the sharp rise in crude oil prices, which has surged to around $80 per barrel, with tensions escalating in the Middle East, particularly due to the Israel Hamas conflict. The global supply of crude oil is under pressure. Experts believe oil prices could rise to the $100 mark if the war doesn't cool off. This spike is critical for India as the country imports nearly 85% of its oil, making it the third largest oil importer globally. So, rising crude oil prices lead to higher fuel costs, which ripple through the economy, increasing transportation and manufacturing costs, and driving up inflation. As inflation rises, the RBI may be forced to adopt a more hawkish stance, potentially keeping the rate higher for long, which further dampens consumption and investments. So, in this scenario, companies across various sectors would face higher operating costs, adding pressure to corporate earnings just because of the rising crude oil prices. Another major reason for the market fall is the higher market valuation. So, before the correction, the Indian market was trading at elevated valuations. So, the Nifty 50 was valued at 21.5 times forward earnings, well above its historical average of 20.4 times. And when compared to other global markets, particularly China and even the US, Indian equities appeared expensive. Additionally, the Warren Buffett indicator, which compares the market cap to GDP ratio, stood at 112% for India, signaling that the market could be overvalued. Historically, when this ratio exceeds 100%, markets tend to correct, as seen during the 2021 market crash when the indicator touched 120%. Therefore, elevated valuations combined with rising interest rates have contributed to the recent sell off. On, another major reason for the market fall is the massive FPI outflows or the foreign portfolio investor outflows. So, foreign investors have sold nearly 27,000 crore worth of Indian equities in just a few days, largely due to the recent rally in the Chinese market. The People's Bank of China recently cut its reserve requirement ratio by 50 basis points, injecting nearly $140 billion in liquidity into the Chinese market. With easing mortgage rates and fiscal stimulus, Chinese stocks have become more attractive to foreign investors. The Hang Seng index is up by more than 26% in the last month. Markets more competitive than the Indian market, which is trading at higher valuations of 21.5 times forward earnings compared to China's 10.8 times. So this valuation disparity has led to a real reallocation of FPI flows, causing a sharp sell-off in the Indian equities. The geopolitical and domestic political risk adding to the external pressures, India is also facing domestic political uncertainty with state elections in Haryana and Jammu Kashmir. Exit polls suggest a loss for the ruling BJP in Jammu and Kashmir, which has caused nervousness among investors. So, historically, political instability has led to the market volatility. And while state elections may not have a direct and long term impact on the market, it still creates a little bit uncertainty. So the question is, what should investors do? At this point, it's crucial to start building some cash positions. So the market is facing significant macro headwinds, including rising crude oil prices, FPI outflows, and political risk. And there's no clear sign of when these factors will ease. While continuing with SIPs is a good strategy to benefit from rupee cost averaging, having some cash positions and cash on hand provides flexibility. If the market falls, you could deploy the cash and you could seize the opportunity. The Indian rupee has fallen below the $84 mark for the first time in history. So, this is a major concern for India also. And because of this, the market could fall further because from the past 5 to 6 years, the rupee has been constantly weakening against the US dollar, and it's a big negative for the Indian economy. In my opinion, if the market falls further, potentially another 5%, making it overall 10% fall, it would present more attractive buying opportunities, especially in sectors like banking, which has not performed at all, and IT and infra. So no one knows what exactly is coming next. But with geopolitical risks such as rumors of Iran conducting nuclear tests, the situation is unpredictable. So as a smart investor, it's essential to be cautious and prepared, knowing when to put money into the market and when to hold back. So, in my opinion, you should hold some cash positions right now. You can build some cash positions with you. You can make a FD out of it or whatever. But I don't think putting large amounts of money, big chunks of money right now in the market is good. And also, if you're dependent on the SIP, so you couldn't just downgrade your SIP. For example, if you're doing a SIP of 5,000, you could make it to 2,500. So that will mitigate your risk, and in future if the market falls, it could give you a better opportunity to buy more good positions. In summary, let's build some cash positions and wait for better opportunities when valuations become more attractive. So stay informed and let me know how that works.